It is October 2023. What can you do with the last 2 months of the year to improve your tax situation? We're going to break all of that down next. Welcome to Office Hours, a tax podcast by Fujikawa and Associates, and we're your hosts. I'm Josh Baldovino, one of Derek's clients, and Derek Fujikawa is a managing partner of Fujikawa and Associates. Derek, how you doing today?
Good, thank you. How are you doing?
I'm good. It is getting colder, although I did just switch from my sweater, and it's October, the end of the year. In the terms of how busy it is for the firm, how busy would you say it is?
It's relatively slow this time of year. I'm going to build up with kind of year-end tax planning and things like that. But we just got done with the extension deadline. Well, for California, it was a deadline, but for everyone else, it was the extension deadline of October 16th. So that was crazy, getting everything done and getting all the returns out the door. Usually there's a little lull, builds up, and then the holidays hit, slows down again, and then run full bore into tax season.
And then that tax season obviously happens Q1 of next year.
Yes.
And I'm sure the number one question that you get for the most part is, Derek, how can I save more money? And I guess now is the time to do it, right?
Yes. Now's the time to ask those questions, not when we're in April finishing up your taxes.
And for the layman, why is that?
So if you wait until after the end of the year, there's really not a lot you can do. There are some small things you can do, but really not a lot of big things you can do that can really affect your tax return. So once December 31st rolls over into the new year, the year's over. You can't do anything that affects the prior year legally. Yeah, so there's not much you can do, right? So we're in 2023 right now. Next April, we're going to be doing the 2023 tax returns. So now is a time where you can make changes and it'll actually affect your bottom line. So now is the time to make any changes, make any big decisions, do things that will help that number and hopefully bring your tax number down when we do your return in March, April time.
Okay, so let's dive into it. Whether you are a current client of Derek and you're seeing this, or you have another CPA, we're just going to go over what things you should be doing towards the end of the year to hopefully save you when it's time to file. But let's just jump into what kind of things could be changing come next year. So that means you have to do it this year. I know that there's some change for bonus depreciation. What's happening there?
Yeah, so bonus depreciation is getting phased out. So if you recall, last year, 2022, it was 100%. I guess backtrack. Bonus depreciation is a federal only, or at least in California, it's federal only, that allows you to, any property that you purchase, any equipment, fixed asset that you purchase that has a useful life of 20 years or less, you can write it all off at once using bonus depreciation instead of using the useful life and writing it off over time. And 2022 and a few years prior to that, it was 100%. So anytime you bought a piece of equipment, you could write it off with this bonus depreciation. But starting in 2023 and moving forward, that's getting phased out 20% a year. So this year it's only 80%. Not only, it's still a big number, but it's 80%, not the full 100%. Next year it's going to be 60, next year 40, 20, and then it's going to go away after that.
Could you give me a quick example then of how I could use this 80%?
Yes, yeah. So say you bought a $10,000 piece of equipment. Okay, simplified, it's not this simple, but if you use straight line depreciation over 5 years, you take $2,000 a year and you get to expense $2,000 each year for that $10,000 piece of equipment. It's not that simple, but just for explanation's sake.
Yeah.
So in 2022 and prior, you could take 100% depreciation, so bonus depreciation. And so you could take that $10,000 piece of equipment and write off the full $10,000 on your current year tax return. This year, 2023, since you only get 80%, you can deduct $8,000 of that $10,000 purchase, and then the other $2,000 left, you'll deduct over those 5 years. Next year, $6,000. If you bought it next year, then it would only be $6,000, and the remaining $4,000 would be written off over the next 5 years.
So if we're looking to offset more, obviously now is a better time to do that. If you have some, and then what's an example of something that that you could buy that you could use this on?
Take my business as an accountant, right? They needed a new copier machine. I could buy a new copier or a new printer or a new computer or something like that. If you're in construction, a new piece of equipment, anything that has a useful life of 20 years or less. So
Okay.
taking it to real estate, need some appliances, something like that would be probably the easiest thing to think of.
Perfect. Okay, so moving on to some other changes that could be happening. You mentioned that there's a law that's sunsetting.
Yeah, so the Tax Cuts and Job Act that was enacted, I think in 2016, that's going to sunset after 2025. So not something you have to worry about right now for 2023, but something to think about. That law is going to sunset. So there's certain things that are going to not necessarily go away, but they're going to change. Is it back to the law that was in effect before that law was passed? So like one of the big things, and this doesn't really affect your current tax return, but the estate tax exemption, that's something you want to think about long term, hopefully. Your estate tax exemption right now is almost $13 million. So if you have less than $13 million of assets, you can pass that on to your heirs and you don't have to worry. You don't have to file an estate tax return. You can just pass it on to them. And as long as you have it set up correctly, it'll just pass on to them. But if they don't extend that, that and the tax law just sunsets, that goes down to about, it's going to be somewhere around 6.5, 7 million, which is still a lot of money, but a lot less than 13. So here in California, you have a few properties that could eat up your whole estate tax exemption, and you could have a taxable estate in that case. So then you'll pay estate taxes on anything in excess of that 6.5, $7 million. It doesn't affect your current tax return, but something to think about down the road and something to really start planning for now so that you don't have to worry about it when the time comes. Just setting those types of things up. But other things, there are other things that do affect your current year, your tax return once the law changes back. Currently, your itemized deductions don't get phased out. So you could have $10 million in income and your standard deduction or itemized deductions are not going to phase out. So normally, most parts of the tax law, like the higher your income goes, they start phasing out some of the deductions. You lose some of those deductions. So say you made a $3 million year, a great year, and you had all this money. Normally, your itemized deductions would get phased out and down to even zero, right? You could take the standard deduction, but your itemized deductions would essentially be useless, even if you had tens of thousands of dollars in mortgage interest and property taxes and things like that. Under the current law, they don't phase out. So even whatever your income is, you just get whatever it's on there. But once this law phases out, that phase out is going to come back in. So anyone with a high income could see a reduction in their total deductions, meaning an increase in their taxable income.
Oh, that is significant.
Yeah, it can be. So that one good thing about the phase out is with that tax law, they limited the mortgage interest on your primary residence or your personal residence to a principal amount of $750,000.
Mm-hmm.
The old law was it was limited to $1 million, and then you also could deduct another $100,000 of what they called home equity debt, which didn't have to be tied to the improvement or purchase of the home. It could be used for anything. So you really had $1.1 million available of principal. You could deduct the interest on that on your tax return. What the new law did was, current law did was it capped it at $750,000 of principal and no equity debt was deductible. So that's going to go away if this current law sunsets and no changes are made. So that is a good thing for most taxpayers. There's quite a bit more that's going to happen, but those are some of the highlights.
And as they reach out to you, paint me a picture of how that conversation ideally in your perfect world would go. Like, what questions should we be asking you? What things would you like us as clients to show you now that we're in the last quarter of the year?
Questions that I hear a lot, and you want to ask any accountant, is how long they've been in the business, what type of clients they have. If you have work in a specific industry, you want to know that they at least have some experience in that industry. They don't have to necessarily be the top person, but at least have some experience in that area and know what you're talking about and be able to look for those deductions in those areas. If you're a real estate investor, look for someone that works with real estate investors and maybe is a real estate investor. And then you want to know what their processes are, which ways they like to communicate best, email, phone, text, things like that. The policies are on getting back to you in terms of responding to inquiries, things like that.
On your end, say like we're already clients, a little general gist about the business. Am I hopefully bringing my year-to-date P&Ls to you?
On my end, so if you're a new client coming to me or someone that's a potential new client, I'd like to see your tax return and then any pertinent information to the current year. So sometimes last year's tax return may not be totally relevant to the current year, right? Say you bought a couple of properties or bought a new business this year, that's not going to be on last year's tax return. But it does give me a glimpse into your situation, and then looking at whatever's changed from last year to this year, getting that information, purchase property, the information on that, and maybe a current profit and loss if you have one, things like that. As much information as possible so that we can get off on the right foot.
And then in terms of this like year-end assessment, what are the things are you looking at? Paint me a picture of what things are you asking and looking for. You mentioned stocks before too, things like that.
Yes, stocks. So I guess the first thing is if you're a W-2 employee or have W-2 income, we look at that. You look at your year-to-date, make sure you're having enough withheld. If you're only a W-2 employee, where we're going to look is your year-to-date income, year-to-date withholdings. Make sure you have enough withheld and at least give you an idea of what your taxes are going to be at the end of the year, and you kind of get a decision on what to do there. If you want to take out more from your paycheck and things like that, it could let you know if you're going to be penalized or anything like that if you don't have enough in. Really, the planning comes when you have, say, small businesses or rental properties or things like that. We could take a look at your year-to-date profit and loss and really dig into it and see if there's anything we can do on those sides to make any changes that'll help hopefully affect your year-end net income. And then the other thing you mentioned was stocks too, right? So you want to look at your stock portfolio. A lot of times, not a lot of times, but if you have someone managing your money, you may not be looking at it all the time. And so you just let it go, let someone else manage it. You get to the end of the year, bring your documents in, and you could have a very significant amount of capital gains on there, and nothing you can do at that point, right? Like I was saying, at the end of the year, you sell it now, it's going to go on your next year's tax return, not this year's. But if we look at it now in October and we see, hey, you've got a significant amount of gains, but you also have these other stocks here here that maybe haven't done well during this time, you can use some of those, sell those, and offset some of those gains and minimize your total tax liability.
So I guess the good news is that there's now 2 months still to do
Yes.
something. Relatively a slower time for the firm. So if you wanna knock on Derek's store, his tax shelter she shed there, which actually if you wanna see a tour of, I'll link that video down below. But there sounds like there's a lot of different things that you can still do to help
Yes.
improve your tax situation by the end of the year. So as a client myself, I will probably tag you in just to see exactly what's happening. And then of course
Yes.
encourage you all to then reach out to Derek or anyone else or whoever your CPA is now, just to make sure that you are completely making the best situation for the end of the year. Derek, is there anything else you want to share with the group today?
Just that planning right now, even if you are, like I mentioned before, even if you are just a W 2 employee, and if that's your only source of income, planning is still something you can do at this point of the year. It's not just for people that have businesses and properties and things like that. You could help avoid penalties by looking at your withholdings, if you're maximizing your retirement plans, things like that. So there are things you can do even if you're strictly a W 2 employee or you and your spouse or things like that. Planning isn't just for the ultra rich or the people that have all these complicated businesses. It's something that can be done at any time. And maybe there's nothing we can do, but at least we could give you an idea of what your taxes are going to be at the end of the year too, so you'll be prepared. The worst thing is you finish a tax return on April 10th, find out you owe a bunch of money and you don't have the money to pay it, then what do you do? If you know that you owe this money, sometimes there's nothing we can do. It is what it is. If you're a W-2 employee and you've maxed out your 401k and things like that, and you still owe a big chunk of money, at least if you now you've got 4 or 5 months to plan for it versus 4 or 5 days to plan for it.
So we're just making sure that as the employee myself too, making sure your retirement accounts are maxed out the way that you want it to, shove everything to your Roth, all of that stuff. So again, I will be knocking on that door soon, Derek. I hope whoever's watching is too. I will link all of Derek's contact information down in the description below. But Derek, I appreciate the friendly reminder. And again, it's always an interesting thing to talk about, right? I'm sure like some of these implications could be tens, if not hundreds of thousands of dollars for some people. So,
Potentially, yes. Yeah.
well, awesome. Well, thanks so much, Derek, and
All right.
appreciate
Thank
everyone
you.
watching. If you enjoyed this, make sure to give us a like and subscribe, and we will see you all on the next one.
All right.
Bye, Derek.
Bye.